My name is Darren Wagner. I'm the founder and CEO of Morpheus Trading Group, which I started about almost 10 years ago now. Tonight, thank you for joining us at our live online webinar. Tonight we're going to be discussing potential swing trade setups that we see in the stock market, both stocks and ETFs. And we're also going to provide you with an updated technical view of the broad market, the main stock market indexes. It's definitely a very challenging market, keeping everybody on its toes in both directions, the volatility from day to day. So we're going to try to shed some light on that for you and see if we can make a little bit more sense for you. First of all, the webinar will last about 30 to 45 minutes. And then at the end, we'll have some time for questions and answers, Q&A. So if you have any questions at all, just jot your questions down if you could, please. And then at the end, when we ask questions, you can type your questions in and we'll answer them in the order that they're received. As far as actually the format goes, you can actually record these sessions very easily. If you look on your Go Meet Now module that you see when you logged in, there's a button on the top right side that says record. You can just click that record button and then you'll be able to record the entire session and you can play it back and review it whenever you like. So that's a lot easier than taking notes on everything. So I recommend you do record it. Joining me this evening, I have two other people that are valuable members of Morpheus Trading Group. First of all, we have Rick Petticelli. Rick Petticelli is actually my right-hand man. He's been with Morpheus Trading Group since day one, and basically been working side by side with me ever since the beginning. He's one of the traders of the Morpheus Capital Hedge Fund, because, by the way, we not only talk about the trades we do, we actually trade them with real money in our hedge fund. So Rick is one of the assistant traders, and Rick is also the author of the MTG Stalk Sheet. So for those of you who received the Stalk Sheet newsletter, he's the one who actually does all the research and comes up with the stock picks and the entries and the exits every day. So he's going to be going over with you individual stock setups. And then the second person that's joining us this evening is Ed Balog. Ed is also been in Morpheus for a long time, and he's also one of the traders of our Morpheus Capital Hedge Fund. So, I mean, all of us not only write commentary and provide setups, we all trade real money. That's a very notable point there. And Ed actually is behind the research and coming up with the ETF picks for the Wagner Daily. He helps to write the Wagner Daily as well. So between the three of us, I'm still involved in the day-to-day trading of the fund as well and the newsletters, but it's basically Rick, myself, and Ed are involved in 90% of what you see. So we're going to start things off by turning things over to Ed, and what I'm going to do is switch over the desktop sharing to Ed, and then he'll actually take over.
Well, what I want to do here is sort of put some in context where things are right now in the market, and then go into a few ETFs that I think the potential setups. Today, we saw a lot of chop in the market. We reversed off the highs. We were up probably about 1.5% on a few indices today, and by the close, we were just fractionally up. We only had modest gains coming into the close. So it was a pretty big reversal, and we did see an increase in volume, which tends to suggest that there was selling into strength. Now, one thing I like to look at when I'm getting a feel for the broad market is what's going on with the transports, because your transportation stocks can be a pretty good predictor of sort of a leading indicator predictor of what the health of the overall economy and the health of the market. Here I have the $DJT Dow Jones Transportation Average up, and you can see that recently we broke down from a big support level, and we lost its swing low, and now we've rallied back. But today, the transports probably acted worse than about any sector. We closed in the bottom third of the range, maybe the bottom quarter of the range, after an attempted breakout. and just kind of this whole sector's been languishing for a while now. So now we have a reversal candle in place right here, a very long wick on this candle, close to the bottom of the range, and transportation, below this 2-day low, this candle right here, I'll draw the line. Below this 2-day low, transportation is in trouble. In fact, even below yesterday's low, we could see a pretty broad selling. And notice the volume increase here. The CompX, the Nasdaq, notice how we just rallied back up to this breakout point. Here we had a swing low here, going back into March, then this swing low in June. We broke that. We broke support of that, and now we just rallied back up into that area. And that's how today we struggled getting above there and closed in, the middle of the trading range. So we know there's some hesitation here. Volume picked up, and once again, when you get that kind of price action, especially when you're in a, we know there's a trend reversal underway in the broad market. When you get that kind of price action, it's usually an indication that you have some distribution going on. Now, that certainly it's not to suggest that we couldn't potentially come up and overcut or cut into this 50-period moving average here. I mean, that possibility is still on the table, that we could rally up into here. But frankly, if that happened, I would consider that just even a better scenario for getting short, because if we did reverse off of today's candle and go higher, it's going to just pull a lot more bulls into the market and set things up for probably a bigger fall. But for the moment, we're just going to go by what's in front of us, and it looks like we've got a reversal going here. Looking at another thing I've looked at, I went over the newsletter yesterday, I believe. There's the VIX, and notice here that the VIX we're seeing very similar price action. Notice how this consolidation, we saw this pennant-like formation form here after the breakout. So we had the breakout in the VIX, then we got a bullish pennant-like formation. We get a bullish pennant-like formation, everything tightened up pretty well, and then we had another breakout move, and now we're getting similar action here, where it's not as clean of a setup, but it's certainly we haven't lost support, and we're getting similar price action as such. So now that we have 3 days in a row here in a real tight range, if the VIX gets above this 2-day high right here, the VXX, and that is 39.97, that could trigger a buy for the VXX, and we could have another breakout move. So the fact that this is holding up and it's staying above this 20-period moving average tends to indicate there's more volatility in store for the market. There's a bet going on out there that we're going to see more selling in the market. So those two indicators, the transports and the VIX, are giving us some indication of what's going on. Couple of ETFs. One that I like that's been showing weakness. You can see there's an erosion going on over the past several weeks. Retail's been starting to lose some of its luster. It's been one of the leaders in the market, but more recently it's kind of lagged. And I really like this reversal candle. Notice we got a really exactly what you want to see. Overcut of the 200-period moving average right here, and then just a nasty reversal. Volume was not higher. I mean, I would have liked to have seen a little higher volume here, but still it was pretty strong. And the fact that it picked up into the close, and we reversed and closed in the bottom, say about the bottom 25% of the trading range. So XRT on the short side could very well be in play if we get below yesterday's low, right here, this could be in play on the short side, which is around $49.15 or so, 49.18, somewhere in that range. And you know, I like this mainly because it showed a lot of weakness today in the way it reversed. A lot of things after they sold off, after we got the whipsaw, there were a lot of things that closed in the middle of the trading range. XRT is one of those that really did, and it just didn't show any signs of life. The another XOY, if retail is hurting, you know, you could expect to see some problems with consumer discretionary. And notice here that this horizontal line was the original breakdown point. Now we have a long-legged doji here. The same type situation where it indicates hesitation in the market. And, you know, if we get a move back below yesterday's low, around 37.25, you know, we're dealing with a similar issue there, similar problems. There's one. Let me get to this. DTO. Notice this is the Power Shares crude oil double short. And what I like about DTO is that it's just basically consolidated at its highs at the 20-period moving average. We have a little undercut here, but we're holding up. We haven't lost its support level despite the market rallying. So we've held the support level, and now if we can manage to get back above this 3-day high here, that probably gives us a buy signal. If we can get above the 62.20 mark, that probably will give us a buy signal, and we could get long DTO. The other thing I like with this one is that we've seen some contraction, some volume contraction, and over the past 3 days, volatility contraction. So volume's kind of dried up down in here. And if we can get that move back above the 3-day high, I think we could see some more upside potential here.
Okay, well, thank you, Ed. The takeaway there for me is the fact that when Ed started by going over the broad market indexes there in the beginning, one of the key points here is that when stocks are moving higher within the context of a downtrend, it's important to wait for a reversal signal. You can get obliterated very quickly by trying to short into strength without waiting for some sign of confirmation. So we haven't been real active. We haven't been making many trades over the past week or so because the stock market was in bounce mode off the lows. So, you know, if you're a day trader, that's fine. There's good opportunities available intraday. But as far as swing trading goes, we're not looking to get long and sell something a day or two later when the market starts to show weakness again. So we'd rather go with the trend, put the odds in our favor, wait for the bounce into resistance. The prior, as you can see on the chart of SPY there, that horizontal line is going to be major horizontal price resistance, and it's converging with the 50-day moving average. So when you've got a convergence of resistance, it becomes even more significant. And many of the major indices have a very similar pattern, in fact. So the key, though, is to wait for that actual sign or signal that you're going to get some kind of a reversal day, either a gap down on the open or a gap up that fails and moves lower. We had a little bit of buying into today's close, but that could have been end of month related as well. So the key is going to be the price action tomorrow. If we move below today's lows, that's going to be indicate a likelihood of a resumption of the downtrend. Okay, great. Good commentary there, Ed. So I'm going to turn things over now to Rick, and Rick is going to go over with you some stocks that he likes, individual stock setups. Again, Rick is the one who writes the stock sheet and comes up with the plays and the picks for the stock sheet. So let me turn over the desktop sharing to Rick.
All right, what you guys are looking at right here is a simple little drawing of market structure that I wanted to go over real quick before we get into some setups that we like on the short side. So to clarify things, we're swing traders operating in anywhere from like a week to 3 to 4 weeks. So what we want to do is trade with the intermediate term trend. And so basically this shows what we do. You have a consolidation pattern, which is stage 1. And then you have a stock that breaks out from consolidation, break out, and you do the step ladder type of thing here. That's where you want to get long. You know, that's where you swing trade. That's where you break out trade. And then after a 15-month, 2-year advance, like we've seen over the past 2 years, say, you start to consolidate the highs, chop around, false breakdown, come back up, false breakout, and then you start to sell off. Once you start selling off, you start making lower highs and lower lows. You start getting a swing trading short setup side. You really don't want to be going long around here for more than 2-3 days, and that's for skilled, very skilled short-term traders to go long. Anyone who's gone long the past 3 or 4 days has to be very skilled because the profits can disappear very quickly. So, and it's much harder to control risk when you're going against the intermediate term downtrend, which we would gauge by the 50-day MA that's sloping lower on the S&P 500. So basically right now, we're in a stage 4. We're looking for stocks that are rolling over. And let's get to the setups. By the way, this isn't my creation. This is from Stan Weinstein. Created this in a book called The Secrets of Profiting in Bull and Bear Markets. So I can't take credit for this. It's not so much a secret anymore anyways. It's been around since like 1987, that book. And it's a really good book if you want to learn about market structure. It's about as good as it gets for that. So let's get to the setup. Okay, first setup. Let's get to the weekly chart here I have. This is rack-based hosting. As you can see here, as the market structure I was showing you earlier, we've had a consolidation phase right here. Then you have your breakout, your move up for a good amount of time there. And then you have your consolidation stage 3 phase, and now you're rolling over. So obviously, from what I've shown you, we want to be shorting at here. Now, we don't know how long this lasts. It might go to 25. It may come all the way back down to 18. We don't know. It might not even go below 31. But right now, we want to be swing trading on the short side. So let's drill down to the daily chart. Rax had some humongous distribution here. That's pretty ugly. I don't think anyone wants to be a part of that. Swing trading on the long side. The rallies are quick, very low volume here. And 2 times it's failed to get above the 200-day MA. Today's reversal bar, I guess, is right here. What we'd like to see ideally one more day of sideways action, of stalling, and then a move below the 2-day low here, and a breakdown to the prior low, which is anywhere from like 31 to 32. So that would be a stop above the high there is 6%. So, and the move down is 12%. So it's a 2 to 1. So it's a decent risk reward. It's 2 to 1. If you have, depending on how the market acts, it can turn to 3 or 4 to 1. You don't know. But 2 to 1 seems like a pretty good reward for risk right now. Not bad. So that's the first step. Low. Low's been in a serious downtrend for quite some time now. As you can see, it's clearly violated its prior swing low from last summer. So there's the breakdown. And the first break of an obvious low, they usually run those stops. It's too obvious of a short setup. At this point, you see the break of the short-term uptrend line, the rally into the 20-day EMA, and now you have a bunch of indecision bars here. 1, 2, 3, and this is just a down day on higher volume and another day on heavier than average volume. So we get below 1970, and we were looking at probably a sell off to the 18, 20, or 30 area, and that's about a 4% stop, 4.5% stop with a 8% target, another 2 to 1. So that's a pretty good reward to risk ratio there. And as you can see, it's the same theme throughout, though, in terms of you see a stock rallying on lighter volume into a moving average, and you get to see stalling action. There's no guessing where the move's gonna end. We wait for a short signal. So Novella's pretty much the same as rats. You have a nice consolidation here. You break out, you rally for 917 to 311. I mean, from 2010 to March of 11. You get a false breakout here. Now it's rolling back over and come to the drilling down to the daily chart. You see the sell-off here is pretty severe. And it's now rallying into the 20-day EMA. Weak. It's pretty weak. It's weaker than the market because it's not even going above its prior swing high, which the market, if this was the S&P would be somewhere around here. So it has relative weakness. And today's stalling action on higher volume, it was a gap up and sell off. So not really outside bar, but a pretty ugly gap down and sell off on higher volume. So any fall through below the 2-day, 3-day low here, and you could probably cover around $60 or look for a little bit bigger of a gain if the market's really bad. Just have 2 more setups to go through. Basically the same thing. Caterpillar on the weekly, break of an uptrend, starting to roll over, lower highs, lower lows, same thing going on here. Caterpillar, you have a little bit more volatility, but basically a stab above the prior swing high, big reversal bar and big volume. Whether this goes today, tomorrow, when it's in the next 2-3 days, it's probably going to stall out around here and move back below 90, takes you back down to 80, most likely, if with a weak market. And the last one I have for today is HP. Sort of the same thing again, consolidation, a rally, and it's starting to roll over. And you have a false breakdown, which is the obvious shorts get run. And they get run above this level, and it didn't quite make it to the prior high, which is showing some relative weakness. And it also had a pretty big volume reversal bar today, reversal candle. It's the biggest volume of the entire rally, basically, since the first day it started rallying, since 823. This is the biggest volume spike right here, as you can see. So below today's low, below the 2-day low, you're looking at a test of 48 from 57. So this is all predicated upon the market heading lower. I mean, obviously, the market just goes sideways and continues to push higher. I mean, some of these setups may not even pan out. So, but that's all I have for now.
Okay, great information. Thanks, Rick. Well, one takeaway that I get from what Rick was showing here, and one thing that I want all of you to be aware of, is the fact that notice that all these stocks that Rick pointed out to you, and even the ones that Ed pointed out to you, they're weak. They're weak stocks and they're weak ETFs. They're not near their highs. They're not trending near their highs. There's a handful of stocks in the U.S. market that are still near their highs. The one that everybody knows, of course, is Apple, just as an example. These are not the types of things we look to short. We're trend traders. That means when the market's going up, we buy stocks that are stronger than the market. We buy stocks showing relative strength. When this market's in a downtrend, we sell short, but we look to sell short stocks and ETFs that are weaker than the market, showing relative weakness. That's the same strategy that I teach in my book, Trading ETFs. That's the real important point here. It's very dangerous, and I know because I learned the hard way when I first began trading. I used to think, well, if something's trading at the highs, that means that it hasn't caught up to the rest of the market yet. So I better short that one because that's going to be the best one to sell short, the most potential for profit. But the thing is, if a stock is so strong that it holds near the highs, even as the entire broad market is selling off, then obviously that's telling you something. It doesn't matter why the stock is strong, but the point is that it's not going lower. So if the stock is so strong that it doesn't even go down when the rest of the broad market's going down, it typically is going to be the first stock to rally higher when the market bounces. So that's why we don't sell short strong stocks. We're looking for stocks that have already broken down. Notice in every example that Ed and Rick showed you, every one of these stocks, if you look at the longer term chart, going back several years, they've all broken below support of a multi-year uptrend line and now they're bouncing into new resistance of that uptrend line, because one of the most basic tenets of technical analysis is that a prior level of support becomes the new resistance after the support is broken. So that's the key point here, the key takeaway. And it's really important to look at different time frames, especially in this market right now. If you look, for example, only at the past 3 months, and you look at the screen you see right now, HP, okay, it looks weak, but you really don't have a clue what the big picture is. But if you go back several years, you can see, okay, this stock has broken down already, and now this bounce is only a bounce into resistance. So it's also important to pay close attention to volume. You heard us talk a lot about volume. If we see big volume on the breakdown, that confirms the break of the uptrend. And then if the volume's lighter on the way back up, then that's typically a bearish sign as well. Just looking at the chart you see there with HP, you can see a horizontal price resistance right around 58 from those prior lows in May and June. And that's going to act as your new resistance as well, which and you've got the 200-day moving average there, so all kinds of overhead. Trading is not about being right on every trade. In fact, if you look at our historical performance results over the past 10 years that we've been tracking them on our website, click on performance, you'll see that we've actually, the Stalk sheet that Rick writes, has actually outperformed the S&P 500 cumulative return by about 800%. And the Wagner Dailies outperformed the S&P 500 by several 100% as well. But the takeaway here is it's not because we're right on every trade. In fact, if you look at our statistics, you'll see that we have about a 50 to 60% batting average, meaning that 5 to 6 out of 10 stocks are winners, 4 to 5 of them are losers. But the reason that we're profitable is through firm strategy and managing risk and managing money. Our average winner is always about double the size of our average loser. So we let the profits ride when we're right, and we get out quickly when we're wrong. So it's not you don't have to have a high batting average to make a lot of money in the stock market, is the point that I wanted to make. So good information here. And what I'm going to do now is actually go ahead and open up to questions and answers. One of the first questions that Taz has asked us is, do we care about Fibonacci? And of course, one should never tell a lie. Funny. We do use Fibonacci. We use Fibonacci primarily to predict where a stock is going to have resistance or where it's going to have support. We don't base our decisions primarily on Fibonacci. We found that Fibonacci works very well, but we use Fibonacci more as a confirmation. So for example, if you look at, I think it was IWM has bounced to 50% retracement from its high of July to its low of August, which is a sign where often trends will reverse, or where the trend will continue. The stock will reverse and the trend will continue in the dominant direction. But that's not enough for us to make a trade decision on purely by itself. So in that case, what we actually found is that there's a lot of other resistance right above, which is more significant, but the Fibonacci we do use as a confirmation. If anybody has any other questions, just go ahead and type them in the chat box there, please. So one of the questions, I'm not sure if we answered it or not, but Gracili is asking, do we feel the SPY is going, the S&P, the broad market, you could say, is going back down to retest the August lows? Well, it's we have no way of knowing that. Obviously, if we knew that for sure, we'd be gazillionaires. But all we can say is that we trade with the direction of the trend. And right now, the trend for many months now has been down. And we've not rallied enough to indicate any change in the trend. So until the trend proves otherwise, we must assume the trend will remain intact. So do I think we'll retest the August lows? I don't know, but I would say that we're probably more likely to test the August lows than we are the 2011 highs anytime soon, and simply based on what the trend is showing us. So yeah, basically, we're experiencing a counter trend bounce right now is what we're looking at. We have time for one last question. I'm taking them in the order they're received here, so I'm going to answer Tony's question. Tony is asking us, do we buy anything or are we all short right now? Well, Tony, it really just depends on market conditions. I mean, it wasn't until about a month ago that we were actually shorting anything. We were long pretty much for the whole year because that's the way the trend was. So now the trend is reversed. So we're just, as I've discussed earlier, we're going with the trend. It's not to say that you can't buy anything right now, but as Ed kind of mentioned earlier, the holding periods on the long side must be very, very short right now, because you're fighting a trend that's reversed. So, you can maybe buy something that has momentum hold it for a day or two, but I would recommend leaving that to only if you're an experienced trader. If you're a new trader, that can be very tricky to do. And if you're not comfortable selling short because perhaps you're a new trader, then you have two options. One option is you could actually buy the inverse ETFs, which is also nice for your IRA accounts, which are non-marginable. Many of the ETFs are inverse. The other option you have is simply to sit in cash and wait. And, when I was a new trader, I used to think, I had to be in the market all the time. If I'm not in the market all the time, I'm not doing my job, missing opportunities. But what I eventually learned and got through my thick head was that part of your job as a trader is to only be in the market when the odds are favorable and the odds are conducive to you, having an edge. And if there's no edge in your strategy, then cash is the best position you can be in. And, preservation of capital, if you preserve your capital while the market drops 10%, then you're ahead of 90% of everyone else that's investing in the market. So you can't be afraid to be in cash. And you notice that, we're not afraid to be in shorts, but we wait until the right time. It wasn't until we got some reversal signal today that we were able to actually, start looking at shorts. We had to wait for some confirmation. But it does.
Darren, can I say something?
Yeah, sure. Go ahead, Rick.
What I wanted to say was, for everyone trying to go long and worrying about missing something on the long side, all the the 50 moving average is the intermediate term trend. When you have a downtrending 50-day moving average, you really don't want to be long. And until those 50-day moving averages start trending higher, the market's really not going to go anywhere. You're not going to miss a rally if the 50 MA is going lower. So you might miss some short-term fluctuations, but you're not going to see a stock or an ETF rally 30%, 40% with the 50 MA sloping lower. So it's something, and it's patience, I think, is what we need here for the longs.
Yeah, really good point. Yeah, it's not only the fact that the stocks and the ETFs are below their 50-day MAs, it's that they're sloping lower. You can see on the chart you're looking at there, the teal line is a 50-day moving average. Notice it's sloping lower. And it's not until the 20-day moving average crosses back up through the 50-day and then the 50-day starts to turn higher, that's when the trends actually reverse and are sustainable. But normally that takes several weeks to several months after you've had a correction of this magnitude. So we do have to wrap it up in terms of questions here. It's a great session tonight, great questions, and I really appreciate everybody coming out. Unfortunately, we can't get to everybody's questions, but one thing that we just started doing recently in our services here is actually covering this is our website here you're looking at, morpheustraining.com. We have the Wagner Daily newsletter that we talked about, the stock sheet. But now, this is only about 2 weeks old. We now have a live trading room and Q&A webinars. So every morning from 9:15 to 11:30, we have a one-way broadcast-only room run by Rick and Ed and myself. So there's no chatter or distractions. It's very focused and it's related only to relevant market commentary. That's now included with your subscription. And the Q&A webinars is the point I wanted to make. These webinars we have once a week that we invite all of the people that are just on our free newsletter mailing list to come to. We do limit our time, but if you're actually a paid subscriber to our services, twice a week, every Tuesday and every Wednesday, we have Q&A webinars where you can ask any questions at all about our strategy or trading, or we can look at any charts you like, and that's exclusively for our paid subscribers. So it's a good way to get access directly to the people that write the newsletters and do the trading, a lot more personal than this large webinar that we have today. And one last thing is that I did mention this about a week ago, and it's still going to happen. Since the introduction of the trading room and the Q&A webinars, our prices will be increasing very soon. I would say within the next several days. So I don't know the exact date, but very soon our prices, it's going to be our first price increase since the company was formed 10 years ago. Current subscribers don't need to worry. Your prices will not change. You'll be grandfathered in at the current price, but for new subscribers, after the prices change. The reason I'm telling you that is if you've been thinking about checking us out, you can get a free 1-month trial to our newsletters. And excuse me, if you sign up today, your prices that are on the website right now will be locked in you'll be grandfathered in even when our prices go up if you continue your subscription. So just wanted to point that out. So thanks for coming tonight, everybody. Hope you learned some things and got some good trade ideas. And for our subscribers, we'll see you tomorrow in the trading room. And we'll look forward to seeing the rest of you at our next webinar that we'll have next week. So thanks for coming, everyone. Have a great night.